Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Mark, why don't you handle the ISE First Trust Revere natural gas product?
Okay. Well, this product was a fund that we had partnered with First Trust back in 2007 to launch, and it is a natural gas product. Well, the index is a natural gas index, and what it looks at are companies involved in the natural gas industry. So it provides equity-based exposure to natural gas. As compared to something like UNG, that is a futures-based product. Over the last few years, we've seen some issues with the approach, potential position limit fears back around, I guess, late summer of '08. There were some issues there with do they have enough shares. We saw shares in UNG actually trade as high as an 18 or 19% premium to the underlying, and it was simply because they couldn't utilize the creation redemption process because they literally didn't have any more shares that they could issue. It's a slightly different structure with UNG. That's a 33 Act product. So what they essentially did was issue it as kind of a shelf offering, and then as the shares that they had asked for ran out, they basically couldn't get new shares. And there were other things going on at the time, but essentially between managing the share float, the attendant issues of dealing with contango markets, as well as managing such a large roll month to month, created some issues with that fund. And actually, if you look at the long-term returns of it compared to natural gas spot, it actually does a poor job in really tracking what's going on in the spot market over a long time. Over shorter periods, it does track spot a little better, but as buy and hold, basically there's lots of expense and lots of roll issues, in my opinion anyway, that really detract from the returns there. Looking at something like FCG, which again is an equity-based commodity approach, what ends up happening there is that as natural gas moves around, there's kind of a base level where operating companies will start to make money. When they do, things really take off from there. And what you find is that in periods of depressed natural gas spot prices, FCG and funds like it will actually tend to underperform spot a little. As they get up to that kind of magic price level, things start looking up, and then as that price level gets passed, really things kind of take off. In putting together the index, one of the things that we looked to do was to not just put together kind of a classic benchmark, right? A lot of indexes out there, certainly almost all of I'll call them older ones, but almost all of the established indexes really started out as pure benchmarks. Does this company work in this space? If so, it goes in the benchmark. What we decided to do was deviate from that a little, and this is something that we do with all of our indexes, is we look not only at does this sector make sense to have an index on it, but we try and put together an index which is also investable. It's actionable, right? Because really we're in the business, not the benchmarking business, but we're really in the index licensing business. We want people to not only use our indexes, but be able to use them. So when we put together FUM, which is the ticker for the underlying index for SCG. We're looking at companies that have certain amount, A, of capitalization, but also average daily value traded. We're looking at revenue exposure to natural gas. We're also looking at some fundamentals as well, certainly with FUM. So again, we're not just saying, oh, this is a broad-based natural gas index. We're saying, no, these are really the companies that A, are really in the space, and then B, they're actually not bad companies based on some, based on some basic fundamentals. So I don't know, Steve. I think I may have kind of blown through the next couple of slides.
No. Why don't you take this next one though? And I don't know if this is current. I don't think it is, Mark. But
no. It's as of October month end. Yeah. Again, these are the index. The index is an equal weight index, and so you do see some movement, but not a whole bunch. So the top 10 here really just shows you that there have been a couple of names that have been doing slightly better than the rest. In this case, at this point, looks like Stone Energy had outperformed the broad natural gas marketplace. Mm-hmm. That's pretty much it there.
And here's just a chart. So, hey, Mark, would you go back and talk about, I guess, how spot gas was trading? You had a good point that I didn't even really think about, that you said sort of later in the cycle that FCG might even surpass where spot is, because is that what you were trying to explain? The difference?
Yeah, and in fact, I think there's actually a good example of it. I don't have the chart up right now, but there's a recent presentation that I put together on our copper product. We have the ISE Global Copper Index, which we licensed again out to First Trust. They developed a fund based off it. The ticker is CU. And when you look at copper at the end of last summer through Q3, it had a really good run. I think spot was up something like 10 or 11%. The fund was actually up close to like the mid to high 20s. And it just so happened that it was around kind of a double of what the spot did. But again, the premise here is that there's kind of an inherent leverage in any operating company, right? That when they start making money, they do a little better than what their kind of underlying is. We see this, of course, in economic cycles. Small caps are always the first to come out of the trough. The large caps are the guys who are winning at the top, of the peak, and those kinds of things. It's that same premise, which is brought into kind of a shorter cycle of commodity prices. So.
Makes sense. Okay. Just a little bit about options volatility. Just remember, options pricing is based on the fact that the asset is going to stay in that light blue range. That's a premise. That's an assumption. It's not necessarily true. And what you'll see in products that are, let's say, ETFs, where we have diversification, is that the steepness of that curve, if you will, the normal distribution or the log normal distribution, will be much tighter, meaning that it's more likely that it stays near the mean. It doesn't mean it has to. It's just theoretically. So the volatilities will tend to be lower. In fact, if we go back, you'll notice that the volatilities here are around 20% in FCG, the option volatilities. The underlying index vol is down at about 10, which is quite interesting that the index vol is very, very low. I don't know what that necessarily means. There are many different ramifications of that. But you'll notice that the option volatility will tend to be a little bit higher than the index vol because, again, when you're buying options, at least in ETFs, you'll see that the insurance factor, the limited risk factor, that most times you'll see the option volatilities will tend to be higher than the index volatility, historic volatility. Mark, do you have any points on that?
No, I mean, I think you can, I actually just pulled up a relative strength chart on FCG just to see if I could see if I could add anything to that. But I mean, it's definitely breaking out to the upside.
Yes.
As of late, we've had a really good run here since the end of August. So, but
All right. Well, why don't we? Next session will be next week, next Wednesday, where I'll be talking about some basic options terminology, looking at some examples. But and here's the future webinars. But what I'd like to do, and I'm sure I've gotten a lot of questions, is to go back and ask Mark a lot of your questions. And so if you'll stick around, Mark, you don't mind sticking around for a couple more minutes?
Yeah, no, that's fine.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.